In this video, we're going to be performing a deep dive on the Clorox Company's dividend safety. To begin, let's talk about Clorox's business model. Clorox is a manufacturer and marketer of consumer and professional products, spanning a wide array of categories from charcoal to cleaning supplies to salad dressing. The company was founded in 1913 and trades with a market capitalization of $20 billion. More than 80% of its revenue comes from products that are either number one or number two in their categories. Clorox is a well-known dividend stock because of its compelling track record of dividend growth. With 41 years of consecutive dividend increases, Clorox is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors cannot rely on Clorox's dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Clorox's dividend safety in the context of the company's current earnings. When Clorox reported its second quarter financial results on February 4th, the company announced that it generated adjusted earnings per share of $1.40 in the 3-month reporting period. For context, the company currently pays a quarterly dividend of 96 cents per share, which implies a payout ratio of 69% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Clorox generated adjusted earnings per share of $3.02 through the first 6 months of fiscal 2019 and distributed $1.92 of common share dividends during the same time period for a full-year payout ratio of 64%. The forward-looking outlook is similarly strong. Clorox expects to generate earnings per share between $6.20 and $6.40 in fiscal 2019, and is on pace to pay $3.84 of common share dividends during the same time period, for a full-year payout ratio of 61%. Using earnings, Clorox's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare Clorox's current dividend payment to its free cash flow. Through the first 6 months of fiscal 2019, Clorox generated $449 million of cash flow from operating activities and spent $86 million on capital expenditures for free cash flow of $363 million. The company distributed $245 million of cash dividends during the same time period for a free cash flow dividend payout ratio of 67%. Using free cash flow, our conclusion is the same as when we used earnings to measure Clorox's dividend safety. The company's dividend appears safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Clorox's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Clorox's performance during this time period is shown here. Remarkably, Clorox was actually able to increase its earnings per share each year through the financial crisis of 2007 to 2009. With that in mind, we do not have any concerns about the company's ability to continue paying its dividend during future economic downturns. The last angle that we will use to assess Clorox's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. At the end of the most recent reporting period, Clorox had $2.5 billion of total debt outstanding. The company generated $48 million of interest expense through the first 6 months of the fiscal year, for a weighted average interest rate of 3.8%. The following image shows how changes to Clorox's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As the image shows, Clorox's weighted average interest rate would need to rise to above the 13% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe the company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Clorox's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover ShareDividend's investor education efforts. If you are interested in learning more about our systematic approach to dividend growth investing, visit our website at www.sharedividend.com.